John, it's been a fairly interesting year in the fixed income market, to say the least, peculiar perhaps. What's your current outlook for bonds?
So we're cautiously optimistic for fixed income performance in 2023. I think cautious just given the levels of inflation that we continue to see. A Fed that is, in our estimation, going to continue to push rates up, and what that means for fixed income valuations. Obviously, valuations coming down when interest rates move up. But we're optimistic for really a number of reasons. The first being that the interest rate moves that we've seen over the last 15 months, anywhere from 250 to 450 basis points, we feel, is really behind us. And then you could further that with interest rates in municipals and corporate bonds at levels that investors haven't seen for quite some time. So we think fixed income performs well and is an attractive asset class.
Do you think what happened at Silicon Valley Bank will have further repercussions in the fixed income market? Are you going to see more selling at the long end and a rush to the front end of the curve because banks have to?
I think outside of this brief period of volatility, we don't expect much spillover into the banking system or to the broader fixed income markets. I think it's important for when we do get periods of volatility like this, certainly when we see some of the geopolitical risks such as Russia-Ukraine crisis, it's important for investors to focus on really two things. One is bottom-up credit fundamentals, focused on the winners and the losers, and really look through those macro events. And number two, I think for fixed income in particular, is how much of your portfolio, your client's portfolio, is allocated to cash. And I think the answer for that right now is probably more today than it was certainly last year and the years prior.
And of course, we're still on recession watch. The economic headwinds, they're growing, I suppose. So what's your outlook for corporate bonds? Because those headwinds are going to hit companies.
Absolutely, and we're starting to see that in terms of top-line revenue growth coming down, certainly leverage ticking up a bit. But let's not forget that, in a zero interest rate environment, I think corporations took full advantage of issuing basically free money in the debt markets for a number of years, and therefore balance sheets look quite sizable headed into what we view as an economic slowdown, if not a recessionary environment in the latter stages of this year.
And what about high yield? Because issuance is a big thing in the high yield market. They want to make sure they get the lowest rates possible.
Yeah, I mean, that's an area of the marketplace where they need to come to market, and given these yields that are much higher than what they're used to and what high yield corporations can stomach at the moment, we've seen issuance in the high yield market for corporate bonds fall off a cliff, really.
And what about municipalities? Have they raised all the money they need before rates have really spiked up?
Yeah, so we're definitely seeing that with issuance off in north of 25% on a year-to-date basis compared to last year. I think it's hard to tell what's that a function of. It could be possibly two things. One is just a function of the strength of municipal balance sheets, right? We saw sales tax revenues, income tax revenues, as well as property valuations really above trend line prior to what we saw pre-COVID. Or possibly a second factor, which is just sticker shock, right? Municipalities are not used to seeing 3%, 4%, 5% when they come to the bond market relative to where they've been issuing debt in the previous 2 years.
And then finally, last year shocked a lot of people in the fixed income market. You rarely ever see the 60-40 portfolio, for example, both fall. So was that a one-time occurrence in your view, or should bond investors still be nervous about something like that?
Yeah, I think repositioning portfolios makes more sense to increase your allocation to fixed income, actually. Despite some of the underperformance that we saw last year within fixed income that investors probably aren't used to, I think within investment grade and within municipal bonds in particular, you're still dealing with a mean reverting asset class that, as long as you don't have a default scenario, which we're not projecting, you've got a security that matures at par. And then you look at the relative value of where the yields are at today versus the risks of a recession. We like fixed income, and we actually think investors should be increasing their allocation to fixed income.
All right, well, thanks a lot for coming on and talking about it.
Thanks, Greg.